Hi, and welcome everyone to the Harkin Institute's Lunch and Learn Empowering Businesses, Families, and Communities with Health Savings Plans, Part 3. This is our third and final presentation on ways families can help decrease the amount of money they spend, as well as decrease the amount of taxes they pay towards health insurance and health care. To start off, we have a brief disclaimer just to let everyone know that the speakers you see here today are sharing their personal views and not that of their employers, the state of Iowa, or the Harkin Institute itself. Also, we are professionals not representing you, but simply providing generalized information and knowledge for the community. To disclose to everyone, of course, our information comes from important sources, and we like to cite those sources. In this case, we took large parts of quotations from different IRS publications, Medicare.gov, as well as CMS, also known as the Centers for Medicare and Medicaid Services. Today's presentation, we're going to focus on four things. We're going to recap some of what we learned about FSAs and HSAs, some important vocabulary to assist in future discussions, introduction to less common tax-advantaged accounts, and lastly, we're going to sum it all up and provide a shorthand for both employers and employees as they move forward in their business. So I myself am an attorney here in the state of Iowa, and you're welcome to read about my bio. I'm going to move on to a much more interesting person, Matt Stagner, who I can't speak more highly enough. He is a wonderful guest speaker, but also is an incredible person who does special needs planning for families. And he is really someone in the community that we want people to talk to and speak to before making any changes to anything that could affect their rights or money or obligations before making those changes. So feel free to reach out to him at the end of the presentation or during if you have a question. So why should I open and contribute to my HSA or FSA? As we discussed before, HSAs offer triple tax benefits, but you must have a high deductible, high premium medical plan. FSAs offer double the tax benefits, but you can't have an HDHP. HSAs can be used as a retirement vehicle, as Matt has talked about before in the last presentation, which many don't consider when they sign up for a high deductible plan. FSAs and HSAs create a way to turn $750 of income into $1,000 of post-tax money because of the tax advantage status of your contributions. Employers enjoy a payroll tax break for every dollar contributed by either you, the employee, or the employer, and that's a win-win for everybody involved. If your employer contributes to an HSA, they get an even bigger tax break. Now, an FSA is not for everyone, and why not? Why is it not the best fit for an employer sometimes, or the employee? So FSAs are only available to employers that offer a non-high deductible plan. Employer contributions to FSAs are not tax deductible, so the incentive may not be there. Employers only enjoy payroll tax deductions, which is still a great benefit for employers. The overhead expense of management can be a challenge, especially for those smaller employers that can't spread the cost over many employees. Employees can feel forced to seek medical care because of that whole use it or use it rule with FSAs. And that can be a problem because you don't want to be forced into purchasing something or going for medical care that you feel that you may not need. Because funds may only originate from the employee, maximization of payroll tax reduction company-wide is rarely met. And that's more of an overgeneralization. Your employer can contribute to your FSA, they just likely won't because they won't get a tax rebate. That might make the choice to purchase better health insurance for your employees less financially prudent. So if we look at HSAs now, we think, oh, that solves all of our issues, but they too may not be the best fit. In order to have the ability to make deductible contributions to an HSA, you actually have to have a high deductible plan, which is not the best thing for most job applicants. You want your employer to pay more. A high deductible plan means you, the employee, is paying more. So they're less favorable for working families because of the higher cost to the insureds. Employer must comply with more IRS rules versus only offering an FSA. An FSA is administered by a plan, just like an HSA, but there are more rules attached to an HSA because HSAs are specific to the employee, unlike an FSA, which is owned by the employer. So when you leave an employer and you have an FSA, you lose those funds. If you leave an employer with an HSA, you keep those funds. Your employees must pay out of pocket for all non-preventative care until you meet your deductible. This can be a challenge for lower income employees on HDHPs. Even though your HSA can cover your deductible, it doesn't mean that that can't be closer to $4,000 or so. And that can be very hard for people to reach, even if they max out their HSA. Now, there's some important vocabulary for us to learn, and we're going to switch this over to Matt. And Matt knows a lot about ERISA, and he will tell you more about it right now.
You're far too kind, Brad. Thanks for the introduction and the review of HSAs and FSAs, because I think it's important to kind of keep all of these different types of accounts straight. We'll also try to help you keep some of the terminology straight in your head here. So when we talk about contributions from an ERISA standpoint or from an employee benefit standpoint, or even a retirement standpoint, we'll say contributions is the money that is put in to an account. It could be a participant contribution, meaning the person who's the employee. So if you're working somewhere, you could contribute to certain types of accounts, or it could be an employer contribution, which would be something that your employer puts in on your behalf, whether or not you have to contribute or can contribute at all. So contributions are important. That's how money gets into these accounts for you to use. The excess contribution would be if someone were to exceed the limit that is established by the IRS for this account, they would have an excess contribution, and there's certain rules where you have to get it back out or pay some penalties for doing so. When we say distribution, we're talking about money that comes out of the account. So money that you spend or reimburse for expenses paid. So reimbursement is when not where you get to, sorry, a distribution may be where you use your account to pay the doctor directly. Reimbursement would be you pay the doctor and then you get money from the account to reimburse you, to make you whole after you've already paid for it. And then Brad talked a lot about deductibles. That is the amount that you pay before insurance kicks in. A higher deductible plan just means that you pay the first, $3,000 or $4,000 instead of paying a copay or a lower deductible when you go in to see a doctor. So those terms are just helpful to keep in mind. And then, as everybody loves to talk about taxes, so we can throw in some tax phrases as well. So we're going to talk a lot about tax benefits of these different types of accounts, and you'll hear us talk about what's included in your income and what is excluded from your income. So included just means money that you earn or that's coming into you that adds to the amount that you might have to pay taxes on. The gross income is your total income, the big number on your W-2 forms at the end of the year, the top number that says this is the amount you made before taxes. Adjusted gross income just basically subtracts out some deductions and makes that number a little bit bigger than the actual taxable income, which is the amount that you actually owe taxes on. So you start with the gross number, subtract out credits and then deductions, and then you end up with a taxable amount. That's the amount that you actually have to pay taxes on. You'll hear the terms tax advantaged. You may also hear things like tax free or tax deferred. There's a lot of different ways to say things that are pretty similar, which is that the government can give you a break in special types of accounts on taxes if you follow their rules. And that's really what we're going to be talking a lot about is these different accounts. Each one has their own set of rules and standards that if you follow those rules, you get tax-free or a tax advantage. If you don't follow the rules, then you lose that tax preference or that tax advantage. Deductible expenses. So you have the choice each year when you file your taxes to itemize your deductions or to take the standard deduction. The standard deduction just means everybody gets to take a certain amount off of their gross income to reduce the amount they actually owe taxes on. If you itemize your deductions, that means that you can take all of your expenses that are eligible to be deducted, and add those up and subtract those from your gross income item by item. It's really important to know the difference, because most people will take the standard deduction now based on where that stands with tax law. But those that itemize, you have to keep really good records and keep track of those expenses. But there are certain things that you can take advantage of just because you itemize as compared to somebody who doesn't. Anything to add or anything that we missed there, Brad?
I believe that is it. Yeah, we've discussed this in depth quite a bit in the first two parts, and so I think we're able to move forward from here. Yes.
All right, well, let's talk a little bit about medical expenses. So the IRS defines what they see as qualified medical expenses, and that means things that you can use tax advantaged medical accounts to pay for. So as we mentioned, if you follow the rules, you get tax breaks, and this is a tax break and the specific rules around it. So if you're under age 65 and you take money out that it doesn't follow the rules, it's not a qualified expense, then they can charge you an excise tax or a penalty on those dollars. So you want to stick to qualified medical expenses for medical accounts that are specifically designed for that purpose. But qualified medical expenses can mean a lot of different things to different people. It can be periodic health evaluations, preventative care, all those maintenance things that come up, routine care. It could be vaccinations or quitting smoking or losing weight, those things that can help your health or that are also somewhat preventative. Screening services, so all the different evaluations and tests that you may have to take throughout your lifetime. There can be a lot of things that fall under qualified medical expenses that are not even listed here. Just think about anything related to a medical condition that that helps advance that your well-being based on that diagnosis. So there are, again, a ton of different things that are not listed here that are qualified medical expenses, but you want to pay attention to IRS code section 502 if you want to know the full list, and make sure that whatever you're spending your money on, if it's coming out of a tax advantaged health account, it's for a qualified health related expense.
Thank you for that, Matt. And so just to dovetail off of that, my specialized glasses that a neuro-optician had to design were covered by an HSA because they fall under Section 502 as a qualified medical expense. It was really amazing hearing your talk last month and the huge list of things that people can use with their HSAs. We're going to move forward with what other options are available to both employees and employers. So there's the Archer Medical Savings Account, also known as an Archer MSA. No new Archer accounts can be started since 2007, and you might think, why are we going to talk about it? We'll show you in a short minute. There are also what are called HRAs, or health reimbursement arrangements. And these are excellent for W-2, or what you think of as like 9-to-5 employees, because they're not available to the self-employed. And as we continue, so what is an Archer MSA and why learn about it if you cannot open one? And that's a big issue for a lot of people about why learn something if we can't start it. Well, it turns out a lot of us still have it. And so Archer MSAs were created to help self-employed individuals and employees of certain small employers meet the medical care costs of the account holder, the account holder's spouse, or the account holder's dependents. Archer MSAs are so effective that Congress had to actually end them in 2003 and decided not to renew them in 2007 because it was sinking the federal healthcare budget. That's how effective these accounts were. If you have an Archer MSA, you want to make sure it remains an Archer MSA. And that's why we're including this within the presentation, because 2007 was not very long ago, and a lot of people here in Iowa still have them. If you are married, you want to make sure you can pass on your account without it devolving into a taxable financial account. So how does an Archer MSA work? Because we can't open new ones, we're going to try and move through these a little bit more quickly. So an Archer MSA may receive contributions from an eligible individual and the individual's employer, but not both in the same year. So it's either you or your employer. Contributions by the individual are deductible, whether or not the individual itemizes their deductions. So that's very important because that makes it an above the line deduction, a dollar for dollar. Employer contributions are not included in your income. So it is in many ways sort of like free money with an HSA. Distributions from an Archer MSA that are used to pay qualified medical expenses are not taxed either. So we have that treatment of an FSA or HSA. What made Archer MSAs so fantastic? Archer MSAs, we'll find, are based on a percentage of income, whereas HSAs and FSAs have hard dollar amount caps. And that's where the differential is coming. So self-employed people could choose to save money on health plans by choosing high deductible plans because one can contribute up to 75% of a family's deductible up to your income limit from the Archer MSA contributors. So that means that if your deductible was $4,000, you could put in $3,000. If your deductible, I don't know, was something crazy like $10,000, you could put $7,500 into it. Those are extreme cases. Either way, you're able to put more into it than a typical person with an FSA or HSA. So self-employed people had another great benefit, and that is when you can contribute from your business revenue to a personal Archer MSA. That means that all your contributions are above the line deductions. That means a dollar for dollar you won't have to pay taxes in. Whereas before, your HSA contributions, you don't have to, are not an above the line deduction in that same sense, even though it does bring down your total taxable income. But what it also does is it locks it up there. And whereas if you're a self-employed person, you're also able to get that benefit on the company payroll taxes. So you're getting this cascading benefit. Archer MSAs are also like super IRAs. A sole proprietorship could avoid paying all income tax by putting excess income into their Archer MSAs, which could be used later as an IRA, as contributions can be invested and grow tax-free, similar as we learned about an HSA. So HSAs and FSAs have specific monetary limits rather than a percentage. So to go over this idea real quick, we're going to see how much money one can save and essentially make their taxes disappear. So if your small business made $100,000 in revenue, your small business costs before paying into your Archer MSA were $50,000 itemized, let's say, which include leasing a vehicle, gas, other business expenses, premiums, let's say. Small business income is considered pass-through income to the sole proprietor. So that means I am my company and the company is me in a way. So only a single person is paying taxes, sort of, but there is a corporate entity. Therefore, your business's profits are your profits. We see that with when you see the letters LLC or LLP, in many ways, the business entity and the individual or partner are the same people, are taxed equally. So $50,000 at a federal tax rate of 12% is $2,320 plus $32.16, which is over $5,500. Now, the employee could contribute up to $37,500, reduce their income to $22,500, thereby reducing your tax rate to 10%, or paying a little less than half, $22.50 in federal taxes. $37,500 is more than what you can contribute to your IRA or 401k combined as an individual. Now, you could reduce your individual tax income even further to zero if you contributed the remaining $22,500 into an individual 401k. So you can do both things. You could put money into your Archer MSA, use it as an IRA, and then have a 401k and an IRA also on the side. So all of these contributions will reduce your taxable income to next to zero, and you probably wouldn't owe too much. Now, don't forget, there's also the spouse that could have these plans. There's the children that could have them. So you could see how a sole proprietor can very easily reduce their taxable income to nearly nothing. Now, considerations if you still have an Archer MSA, and this is probably the most important slide on them. Preserve your account's MSA status by naming your spouse as the beneficiary on your Archer MSA. Whomever inherits this or is the beneficiary of the remaining balance in the MSA will owe taxes on that money. And that's where a little bit of the hiccup comes in, is that you want to make sure that your spouse, if you have one, is the beneficiary. Now, that could put those people into an even higher tax bracket, which may not make them happy, because then they owe more taxes, of course. Unlike an IRA or 401k, an MSA has no required minimum deductions. So when you reach the age of, I believe it's 70 and a half now, you have to take a certain percentage out of your IRA or 401k every year. You don't have to do that with an MSA. But after years of those MSA contributions, as you can imagine, growing tax-free, if it became taxable, the tax bill would be quite large, into the tens of thousands of dollars. And we're going to switch now over to HRAs. Now, what is a health reimbursement account? Now, this sounds very similar to the machinations of an FSA or HSA in that we're reimbursing people. But this is a little bit different, as this is a different plan. And this is one plan that has probably the greatest flexibility, but not nearly the ease of an FSA or HSA. So the employer contributes to an account from funds not otherwise going to your salary. And that's the key difference. Money that goes into a health reimbursement arrangement could not be something that someone could point to and say, that dollar you were going to put in or is about to go in wasn't coming from your salary. So the not otherwise going to your salary. Therefore, whether or not someone contributes to your HRA, your salary will always stay the same. So an HRA can only be funded by the employer. Employees may never contribute to an HRA. That will immediately make it taxable, and you will have an excise tax put on it as well. Contributions are not included in your employee income. So you're getting money from your employer, but you don't have to pay for it. It's not available for the self-employed. You see, if it wasn't available for the self-employed, might as well just keep Archer MSAs around. So the IRS got smart, Congress got smart, and they turned off the self-employed switch on HRAs. Contributions do not have to be reported to the IRS. So there's no extra forms. For FSAs and HSAs, you bet there are forms, and you have to fill them out if you are an employer. If you are an employee, you have to hand them over to your accountant. Employer contributions can be rolled over for later years, much like an HSA can do as well, and an MSA. Remember, an FSA cannot roll over except if the plan document allows it to, and typically that does. May be offered with other employer-funded health benefits. And so this is really important in that when you have an HSA or FSA, you're divided. Do you have a low deductible or high deductible plan? That's it. An HRA you can have and still have different types of plans added to it. That creates a lot of flexibility if you're an employer and you're trying to attract a specific target employee group. Now, you're eligible for an HRA if your employer offers it generally, much like an FSA. Employer contributions and HRA distributions. So contributions is money going in, distributions is money going out. There is no limit on the amount of money your employer can contribute to the plan. As an employer, you should not hear this as a shrewd way to give bonuses to good employees, because you have to treat every employee the same. It's part of a test that the IRS has for this. The maximum reimbursement amount credited under the HRA in the future may be increased or decreased by amounts not previously used. And that just means that you can increase the amount of money that you can get from your HRA based upon how little or how much more you will need based upon past expenditures. Generally, distributions from an HRA must be paid to reimburse you for qualified medical expenses you've already incurred. The expense must have been incurred on or after the date you enrolled in the HRA. And that makes sense. I mean, what company is going to accept reimbursement if you weren't part of the plan when you incurred the expense? Of course, this is all forward-looking. Now, you can get debit cards, credit cards, stored value cards, whatever you want from your employer, and that can be used as the reimbursement tool if you are a participant of the HRA. And many of us have our HSA cards, our FSA cards. Now, if you use these cards, though, with an HRA, it's even easier because you don't have to provide nearly as much documentation. Speaking personally, I have an FSA, and even when I use the card, I will be reminded that I have to give documentation within a limited window of time in order to have that recognized as a reimbursement from my FSA. Now, why is an HRA particularly useful for an employee? These are wonderful accounts for both the employer and the employee. I can't put a finer point on this. You can have both an HSA and a limited purpose HRA. But whereas an HSA, you could put money towards long-term care, there's a little quirk here in the law. And so with a limited purpose HRA, you cannot put funds into long-term care. Retirement HRAs pay for medical expenses post-retirement without paying tax, even though contributions were never reported. So this is even more interesting because you can have money in retirement to pay for medical expenses. You're not even working there, and you did not get paid those funds while you were working there. So it's even better for the employee. The maximum reimbursement amount credited under the HRA in the future may be increased or decreased, like we said, based upon amounts not previously used. So if you find that you need an extra $1,000, most of the employees do, the employer can raise what they contribute to the HRA. Now, this can be used to pay for health insurance premiums, as we see on slide 2. Can be used to pay for long-term care coverage. These are just for HRAs. So even though I said you can't pay for long-term care coverage in the last slide, that was from a limited purpose HRA. This is if you have a full purpose HRA. These can be used to pay for amounts not covered under another health plan. So that's really important. So if you have multiple plans, this can cover those gaps. That's very useful. HRAs are essentially FSAs with a higher amount available for distribution, but no payroll deduction because it's not paid out of your salary. That's a very important point. When we're deciding on health insurance plans, many of us will get wooed in by the idea of, oh, I don't have to pay taxes on this money I contribute to my FSA or HSA. Well, in HRA, the money is coming from the money otherwise not put into your salary. So there is no salary deduction because if there was no money put in that year for the HRA, your salary is going to be the same. So that's one thing that people will get hung up on and not choose an HRA and ignore all the other benefits with it. Now, an HRA can cover non-medical expenses, but any distribution, including the reimbursements of qualified medical expenses made in that current tax year, is then included in your gross income. So this sounds like you're paying extra taxes. What this is the HRA version of an excise tax. You can take out money from your HSA to pay for non-medical expenses, but you're going to be paying income taxes and an excise tax. In this case, you're not only going to be paying income tax on the non-medical expense that was reimbursed, you're also going to be paying income taxes on that entire year's distribution from an HRA. So that doesn't mean the entire value and balance of your HRA. It's just what is being distributed that year. You'll have to pay income taxes on. So it's trying to stop you from using it as a non-medical reimbursement method. Now, if the plan permits amounts to be paid as medical benefits to a designated beneficiary other than you or your spouse or dependents, any distributions from the HRA are also included in income. So if you find yourself wanting to take money to pay for a friend or let's say your grandparent even for their medical expenses, just know you're opening yourself up for greater tax exposure. Now, why is an HRA particularly useful for an employer? Now, you can receive the same tax advantage status as other cafeteria plans. Cafeteria plans are what most of us have. We're shown kind of like it looks like that table where on one side you list all the different possible benefits, and on the top list the different types of plans. That means it's a cafeteria plan, in that you kind of have this menu you can pick and choose at the buffet. You can receive similar deductions as other plan contributions. You can offer the greatest flexibility to your employees. It can lower your payroll taxes more than an HSA or FSA if you're able to offer lower salaries in exchange for higher contributions to an employer's HRA accounts. Now, this is dependent on the whole point of an HRA is not part of your salary. And because an HRA cannot take salary-based dollars to be contributed into it, all employees must be offered the same benefits. If you want to reduce your payroll taxes, you do have to reduce employee salaries, but you say to them, wait, you know, we're in the middle of COVID, let's say, and everyone's going to have higher medical expenses. We're going to reduce employee income, but we're going to put more into your HRA because so much is up in the air for everyone right now. And as an employee, you might say, not such a bad payoff right there. Allows for greater employee retention because employees do not need to contribute to receive a benefit. And that's a real win for everyone. There's no limit on the amount of money you can contribute to your employee accounts. Now, that's a great way to lower taxes if profits spike during a planned grace period. So, and I said, be careful of this. So there's always open enrollment. There's where plans come right up to one another. There are grace periods in between them. If profits really spike, or they're expected to spike, and you have to choose a new plan, and that's when the plan is open, you as the employer can decide to put more money in because that's all dollar for dollar above the line tax deduction for the company. You can save even more money and help your employees even more. And so that really gives you the option to not only reduce your taxes, but also to keep your employees. Why are HRAs not more common? So an employer wants to receive specialized tax treatment for all healthcare related expenses, and we can see that under IRS Section 215. In order to keep this special status, you have to comply with very strict rules, like all other accounts. Now, you may not be filing more paperwork, but they're going to have more rules possibly because you can have an HRA, a limited use one, plus an HSA within there, and maybe property and casualty you offer to people, and life insurance and all that stuff. So you just have to be careful that all of that jives together, so not as to make any of your contributions as the employer not deductible, because that would just be shooting yourself in the foot. Now, this option can be offered in conjunction with other traditional cafeteria plan offerings. Therefore, employer and employee contributions must be monitored to prevent loss of tax advantage status. We've already said that only employers can contribute, so how could employee contributions even exist or mess up anything? Well, it's if the employer has a cafeteria plan that offers, and so they're sponsoring the plan. They're not necessarily paying for every part of it. If in the cafeteria plan, they're offering to their employees, let's say life insurance, that's offering you the opportunity to pay a money to the plan administrator due to the sponsorship of your employer. So that payment you make is coming from your salary. Now, the payments made to the HRA have to be coming from the employer. So you have some dollars flagged as yours, some dollars flagged as theirs, and you might have property and casualty, or let's say extreme casualty health insurance, like let's say some people have a cancer policy if they're suddenly diagnosed. That can be mixed dollars. So each of these have different treatment, and you just have to be careful. Plan administrators are very good at all of this. So before you get scared as an employer, just think, let me talk to someone like Matt beforehand that can help me walk through this process. The IRS uses a magic, I used this in jest, uses a magical divining rod to determine if your HRA is an allowable Section 215 deduction. That compares employer contributions to overall cost of the plan to the employee. This can create a lot of confusion for employers. if your plan, I'm sorry, if the cost of the employee is, let's say, that you have a high deductible plan and your HRA coming from the employer is nearly a perfect match, you're basically paying completely for their health insurance. So is this really a specialized account for reimbursement if you're already covering all of their deductible and you sign them up for a high deductible plan? So that double dipping effect, the IRS uses a very, very non-standardized test, we'll call it, to figure out if it qualifies under Section 215. The IRS has what are called decisions. So these are private letter decisions that only apply typically to the person that contributed the question to be determined. But other people can use it as a basis for moving forward, but it doesn't guarantee them the same outcome. So there's a lot of flexibility here you see with HRAs if you're allowed to essentially negotiate with the IRS to see what you can do. And as an employer, why wouldn't you push the limits? I mean, if it's going to help your employees too. So consider this if you use HRAs for non-qualified expenses. If an unused reimbursement is payable to you in cash at the end of the year or upon termination of your employment, any distribution for that year from the HRA is included in your income. So keep that in mind. All distributions from that taxable year left unused upon your death that is not left to a spouse is taxable to your estate. Now, we've brought that up before, that if you leave it to a non-spouse beneficiary, that beneficiary is going to get saddled with a whole bunch of taxes that they have to pay. But if you don't leave it to anyone, you don't name a beneficiary, someone has to get that money. And in the United States, that's your estate. And so your estate is going to have a whole bunch of taxes to pay. And that means that you're going to be giving less to your loved ones. So make sure you always assign a beneficiary. If the HRA provides an option for you to transfer any unused reimbursement at the end of the year to a retirement plan, then all of that year's distributions are included within your gross income. So in many ways, if you want to transfer from an HRA money into a retirement account, it's going to be just the same as a Roth IRA. Roth IRA means you're paying income on the front side and not the back side when you distribute it. None of this applies to the overall tax status of the cafeteria plan by the plan sponsor. So whatever happens to expenses, let's say on your side, you're trying to get money out of it, it does not affect the employer because that could affect 100 other people. So some mistakes that we make on our own are our own. Now, Medicare Advantage MSAs are well known by a very, very fantastic guest speaker we have today, which is Matt. And Matt, I would love for you to tell our audience more about Medicare Advantage MSAs.
Well, I appreciate it. There's a lot of information there in the last two sections about both the Archer MSA and the HRA, which are useful tools for employers to provide extra benefits to help their employees pay for medical costs. Well, for those that maybe aren't employed, maybe you're retired or maybe you have a disability, if you're eligible for Medicare, you're going to have a lot of different options for Medicare coverage. You've probably heard of all the different letters here. Part A, which is the traditional Medicare coverage for big, large medical expenses. There's Part B, which is more like your basic hospital and doctor visits. And then you have the option, in addition to Part A and Part B, to add a whole bunch of other stuff to your Medicare coverage to make sure that you're paying less and less out of pocket. That could be a Medicare supplement or a Medigap plan. That gives you more options on where you can go, more things are paid for. It covers some of those gaps that Medicare doesn't. Or you can scrap AB and the supplemental plan and go with a Medicare Advantage plan. Now, this is really just a way, in essence, to take your Medicare from the U.S. government's Medicare program to an insurance company's Medicare program. Medicare Advantage Part C is going to feel a lot more like what your employer coverage may have, especially if you had a low deductible employee healthcare plan like a PPO or a POS type plan, where you're going to go to the doctor, you're going to get a copay, you're going to have an in-network number of providers that you can see. If If you see somebody outside the provider, you're going to have to pay more than that, and the premiums are generally going to be pretty low. So it's a way to take Medicare coverage, put it with a private insurance company, and make it potentially less out of pocket for the individual. But what a lot of people maybe aren't aware is that you could have a Medicare Advantage plan that has a high deductible. And this is maybe a less common scenario, but in that case, if you have a high deductible Medicare Advantage plan, you can pair that with an MSA, which is a Medicare Advantage plan that acts a little bit like an HSA. So it's a medical savings account that is tax advantage, but it's money that's paid in by Medicare. And it's designed to basically keep your expenses low, but to reimburse you for qualified expenses that you have in relation to your medical conditions under a Medicare Advantage high deductible plan. So again, think of it like an HSA in some ways, that is paired with the higher deduction, the higher deductible plan. It's there for your qualified expenses, except you're not putting the money away. Medicare is. So it's a way to get probably a very low premium on your Medicare Advantage plan because you're accepting a higher deductible. And as a way to help offset that, Medicare puts aside some money for you to pay what they're not going to pay for. You can carry over contributions. It's pretty flexible for those that use the MSA as an individual. And it's an account that, again, is going to look and feel maybe similar to what your HSA might if you had an HSA through your high deductible employer plan or through a plan that you bought on the healthcare exchange. To be eligible for this, you have to be eligible for Medicare. So either a chronic kidney disease, ALS, or one of those other conditions that are listed on Medicare's list of allowances, or if you have SSDI, so Social Security Disability Insurance, that means you have a disability and you filed for federal benefits. It's essentially like taking your Social Security retirement early because you have a disability that affects your ability to work. Once you're on SSDI, after the first check you receive from SSDI, 24 months later, 2 years later, you can get Medicare coverage, which means you'll have all the options of Medicare, whether you're doing Part A, B, and a Medigap coverage, or you're using a Medicare Advantage plan with an MSA, as discussed. So you have to have Medicare coverage. You have to be covered in the U.S. and in the area where that plan exists. You're not eligible for an MSA if you have other benefits that are going to pay that deductible. So if you don't have the big deductible, you don't get the benefit to help pay that deductible. So if you still have employer coverage, if you work for a union that provides healthcare coverage into retirement, you have a different Medicare Advantage plan in addition to this one somehow. You get TRICARE or federal government employee plan, or you get Medicaid. Those are programs, again, that are going to pay more of those expenses. They're not coming out of your pocket. Therefore, you don't get their preferred reimbursement through your MSA plan that Medicare could otherwise do. If you're living outside of the U.S. more than 183 days a year, you're not really a participant in the U.S. healthcare system, and therefore they're not going to give you reimbursement or qualified reimbursements from an MSA to be able to pay your healthcare expenses. So it is a sort of a special type of savings account. Medicare is determining the amount they're putting the money in. It's all based on your plan and the agreements that come along with it. If you're entitled to Medicare the entire year, you'll probably get that in the beginning of the year. If you become entitled to Medicare later on in the year, then you'll have money put into this MSA account, if eligible, whenever that coverage starts in the first month. You can use that to pay any covered cost up to that plan deductible. You can access that account through a couple different ways, however the plan is set up, whether it has a debit card, checking account, whatever. Pay attention to the plan's fine print and how you can access those funds and make sure it fits your needs before enrolling in an MSA. There's a couple of questions you probably want to ask yourself. I mean, I think really one of the purposes of this entire series is we're trying to equip you with information about these different types of plans, but also how do you decide what's the right one for you? If you're looking at a Medicare Advantage MSA, again, these are very specialized types of accounts, and then they're going to be different based on where you live. You're going to want to ask a lot of questions or look into the fine print to determine how much you get deposited each year as compared to how much your deductible is. Then you start to think about how those expenses count, how much you're going to be paying out of pocket versus when Medicare or your MSA will kick in. And you want to pay attention to if you have coverage for dental and vision and long-term care and preventative services. All of those things may be a little bit different depending on which plan you're enrolled in. And so you'll want to really, again, pay attention to the fine print and to those details. Iowa has a Medicare resource that helps you get some information and talk to somebody if you have questions about an MSA or about your Medicare coverage or about what's covered and what's not. We provided the website here for you to take a look at, but it's important, again, for you to really understand your Medicare coverage, whether it's an MSA with a high deductible Medicare Advantage plan, or you have other Medicare coverages. It can get confusing. There can be a lot of options, a lot of choices. Talk to your healthcare professionals. If you may have an insurance professional that you work with that's an expert in these fields, or a financial planner, or somebody like Brad, of course, they can help give you some answers as you look to navigate to what a lot of people call alphabet soup as it relates to Medicare and healthcare Advantage plans, because there are so many different options, so many different abbreviations and acronyms. It's hard to
So
keep track.
I do want to jump in with Matt's great review there of the questions. The last part, the SHIP SMP, that is a free resource that our tax dollars and federal dollars pay for so that you, the individual, do not have to. All of these questions, you could quintuple them and you'll still have more questions. So you can call your state's SMP or SHIP office in the state of Iowa. That is SHIP, SHIIP. .iowa.gov, and they will help provide a service to you for free. They will also send you materials, contact insurance companies for you. It's a really excellent program here for Iowans.
Absolutely. Take advantage of the resources out there. Have the right team around you. Ask questions. Make sure that you have a full understanding of what you're getting into before you sign up for any type of plan, any type of financial account. I think that's something that's really, really important, is making sure you understand it and you get the right help to help you through that. So we're just about out of time. So we wanted to do a quick recap of all the different healthcare tax advantage account options that you may have and why you might want to use one versus the other. So this is, again, opinion of the presenters, not necessarily of any institution, but these are pretty good rules, shorthand rules that you can remember. If you have a low deductible healthcare plan through your employer, an FSA is probably going to be your option. That's the kind that you put money into from your paycheck, and you have to use it before the end of the year. If you have a high deductible plan through work, then HSA is probably going to be a great fit for you, because it's like an FSA, except for you can contribute to it, keep it, invest it for the long term, but is paired only with those high deductible plans. For self-employed people, HSAs can give you a bigger tax break. You can think about it almost as another retirement account, an investment tool that you can build over time for future expenses. Now, if you're already over age 65 and enrolled in Medicare, or are about to enroll in Medicare, if you're in good health, that Medicare Advantage MSA could be a good fit. Why do we say in good health? Because high deductible plans cause you to pay more out of pocket. Now, you may have the MSA to reimburse you, or you may have an HSA on a high deductible plan while you're employed, but you're still paying those expenses up front, and there may be more than what your account balance can handle. So if you don't have a lot of substantial medical expenses, a higher deductible plan is often a great choice for you, whether it's through your employer or through a Medicare Advantage plan with an MSA. if you're changing things around, which is this happens to a lot of us, you're changing jobs, your employer changed what's available. If you had the HSA before, now there's an FSA available, you can still keep that HSA balance. You're not going to contribute to it anymore if you're not eligible, but you have the option to keep that HSA for the long term, use it in the future, use it to pay for healthcare expenses now or even on into retirement. So that's a great tip. If your employer changes and you're no longer HSA eligible, that doesn't mean you have to surrender your HSA account. You can just start contributing to the FSA separately and not to the HSA. If your employer has an HRA, you better ask some questions because as Brad pointed out, they're very flexible for the employer, which means the employer can customize it to fit their employees and their needs. So it's hard for us to tell you exactly how it's going to work because it's going to vary depending on who your employer is. So ask lots of good questions. And as Brad mentioned, if you happen to have one of those old Archer MSAs, make sure you keep it in Archer MSA because your tax benefits are going to go away if you lose that, and you won't be able to start a new Archer because the tax laws change there. So definitely talk to your financial professionals. If you have a financial planner, if you have an HR representative that helps you with benefits, if you have a benefits counselor, make sure you're making the most of what's available through work. Make sure you're making the most of what's available through the government. The benefits are there for a reason, as Brad always brings up. They're paid for by tax dollars for a reason. We should be using them for that reason and making sure that we're not leaving money on the table. I'll let Brad finish up by talking about the employer perspective and why you might offer one versus the other if you have employees.
Thank you so much, Matt. One of the things I do want to go back to from part two was I learned so much from Matt and from not only him, but also from other people's questions we've been getting in. And he's demonstrated that HSAs can be used for so much more than we ever understood, especially as an IRA. And so I really want to drive that point home before talking about good points for employers to consider. Offering tax-advantaged accounts improves employee retention. More money you give employees, the more likely they're going to stay. It's not exactly rocket science. Encouraging employees to contribute to their FSAs and HSAs, though, that will lower your payroll taxes. It's important, though, with marketing. Tell them to contribute. Encourage them to contribute. You can give them de minimis prizes for contributing, like a little trophy or certificate. Contributions to FSAs are not deductible to employers. They're only deductible to the employees. Contributions to HSAs are deductible to an employer and the employee if both parties are contributing. Now, consider the enormous benefit of HRAs to your employees. If you are an employer, do not discount it because it's a new acronym within the alphabet soup that we've been hearing. Offer the most flexible health plans to attract and retain the most highly qualified employees. This does not mean if you've chosen a health plan in year one, you have to stick with it for the next 100 years. Every year is your opportunity to try something new based upon employee feedback. Be creative and work with a financial planner with expertise in employee benefits because you want to get the most on your return on investment as the employer. That's the whole reason you're there, is to make money. Now, follow all IRS rules to maintain the deductibility of your plan contributions. I can't say this enough. If you make one error, sometimes that could lead to all of your plan contributions to be made IRS non-deductible, and that just means you spent a lot of money for nothing. So you want to keep all your plan contributions deductible from your taxes as a small business owner or an employer. So follow all those rules, work with your plan administrator, but as always, speak to an expert before making these large decisions that can cost you or your company several hundreds of $1,000s or millions of dollars. So pick well, talk to your employees, and hopefully you'll be able to not only enrich their lives, but also enrich your pockets as the employer. And we just want to say thank you. Thank you so much for attending our presentation today. Once again, if you have any questions, my name is Brad Byron, and my co-presenter here is Matt Stagner. You're welcome to contact us through the Harkin Institute or the Harkin Institute directly. Thank you for coming today, and we look forward to seeing you next month.